Good morning. My name is Marc and I'm the Senior Counsel in Thompson Hine's Investment Management and Business Litigation Practice Groups. I'd like to welcome you to today's webinar. This is the second in a series of 3 webinars targeting issues that focus on the SEC's recent guidance on common compliance issues. I wanted to make sure we had our panelists with us if they could check in.
Hi, good morning, Marc. It's Salvatore, Faia, President.
Hi, Marc. Ryan Wheeler.
CEO. Sorry, Ryan.
Hi, Marc. This is Craig Morshed, Foresight Financial.
Hi, Marc. Salvatore, Faia, President and CEO.
Hey, Marc. Ryan Wheeler, Thompson Hine.
Excellent. Excellent. So to decipher that a little bit, I'm delighted to have with us today the panelists who will be joining me for our discussion. If you didn't catch their names, that's Salvatore, founder and president of Vigilant Compliance, Craig Morshed, managing director of Foresight, and my Thompson Hine colleague, Ryan Wheeler. We're excited to have them. So let's dive in. Some of you may have joined us for the first of the series addressing the recent SEC pronouncements in an OC risk alert relating to private funds and common issues that they have had that through examination the SEC has provided this risk alert to discuss issues that jumped out to them as being most prevalent. So the webinar this webinar will cover conflicts of interest. We covered conflicts of interest. It was the predominant issue that was a part of the risk alert. But the risk alert covers 3 topics in total: conflicts of interest, fees and expenses, and code of ethics. Issues 2 and 3 we'll get to in an upcoming conversation. I've introduced our panelists for today. We're excited to have them with us for an interesting discussion. Before we dive into the specific conflicts, we had a really scintillating discussion about what this risk alert means, and hopefully we'll have an opportunity to dive in a little deeper here today. Those who practice in this area may be aware that there have been 2 other risk alerts related to this topic that seem to cover many of the same types of disclosure issues. We're going to discuss whether that means something in particular, whether the SEC and OC simply issue these reminders every few years, and hopefully unpeel a little bit of the onion about whether this represents any heightened scrutiny and how institutions should be responding to it. So the first topic that we'll cover are conflicts related to service providers, which the SEC and OC's risk alert characterizes inadequate disclosures relating to service providers and private funds. They gave several examples in the risk alert, but obviously conflicts related to service providers is something that has come up before, and a topic that bears repeating today. So I'll start with this question. And as much as the SEC and the OC risk alert makes references to relationships with affiliated and unaffiliated entities, how should advisors handle situations where portfolio companies controlled by advisors have service agreements with entities that are controlled by or affiliated with the advisor? Salvatore, I'd like your thoughts on this matter.
Sure, Marc, thank you, and thank you for the Thompson Hine team setting up this seminar. So service providers are often, especially in the private fund / hedge fund context, are often affiliated. So they might provide, for example, valuation services because they're often valuating not publicly traded securities. They might do the fund accounting related there too. So a couple key points you should be aware of. So watch number one relating to disclosure. So you want to disclose the affiliation of the service provider, and you want to disclose how they're affiliated with the advisor, and what services they're going to be performing. That's number one. Number two, another key thing is you never want to put language in to the agreements that are signed that state, for example, that the fund will pay no greater amount using your affiliated service provider than another service provider. We saw this happen with a major BDC company, and Counsel was very strong in saying you should put in this language. And then when the SEC came in, we thought it was a bad idea. The SEC came in and they said, well, you state that the advisor will charge no more than what they should have been, than they would have paid with someone else. Tell us how you prove that up. Did you go out for an RFP? And what the advisor was left saying, well, we never went out for an RFP, number one, and number two, we don't think somebody out there will provide all these services. A very bad answer, and it got the advisor in a lot of trouble. So you want to just use the general fiduciary standard. You want to disclose it and then state the services performed, but leave out any extra claim that you might have to prove up when the SEC comes in.
That's an interesting and telling story. As a follow-up to that, are you saying that less is more in your description?
I would certainly say put in the types of services that you're going to provide and how they're going to be priced. So cover the key areas: valuation, fund accounting, whatever services that, board services, whatever services you're going to provide, certainly disclose those, and then say it will be, the contract will be approved by the board or by the general partner or whoever's going to approve it. Don't try to go too far in saying, and the services will be fairly priced and the services will be the best that are available, because when the SEC comes in, they're going to ask you to prove that up, how you prove that, and you don't want to be in a situation where A, you can't prove it, or B, you never went out to other service providers, which is a lot of work to do. So just, I'd say enough is enough, but too much is problematic.
All right, too much is problematic. I like that. Ryan, did you have any thoughts on the topic of conflicts related to service providers?
Hi, Mark. Absolutely. I think stepping back maybe and just looking at conflicts broadly, you can kind of set up a toolkit for the advisor to use when analyzing any conflict. So if you walk through these steps, and I'll walk through these steps with with each of the conflicts we discussed here today, but if you walk through the steps, it'll definitely help you use best practices when dealing with these issues. So first, I would say identify any potential conflict of interest. That's really the first item in the toolkit. With respect to affiliated service providers and unaffiliated service providers who may have an incentive for the advisor, I mean, that's something that the advisor is easily going to be able to know. And everything Sal said, I agree with. So a lot of this is just trying to put a wrapper around it. So identify is the first step in this toolkit. Second step would be, to the extent possible, the OCIE really wants to see advisors avoid or at least mitigate the conflict if possible. That's obviously not always the case, but that's something that I think is worth adding to the toolkit. Thirdly, provide adequate, full, and fair disclosure so that investors are able to make informed decisions regarding everything. So this could be using an advisory board. So investors on behalf of other investors are consenting or at least aware of what's going on up front with respect to service providers. ADV, of course, is an important disclosure document, and then fund documents, your PPM, need to contain disclosures that you're potentially using these affiliated service providers. You can't disclose away your fiduciary duty, however, though. So to Sal's point, I think it's number 4, very important to implement policies and procedures to monitor these conflicts. So have policies and procedures from the start with respect to, processes around service provider due diligence. To Sal's point earlier, you can't just make a blanket statement that other service providers aren't going to be able to provide the same level of service. So you actually need to get out and conduct your own due diligence, and you need to be able to document it. That's, if you're using an affiliate, that's going to be one of the first things that the SEC is going to want to see as part of your policies and procedures. What did you use? What metrics did you compare? It doesn't necessarily mean that you have to find a cheaper service provider, but you certainly want to be able to find one that provides comparable services, quality services, for a reasonable price, with the whole idea that you're doing this in the best interest of the underlying investor. And then lastly in this toolkit is really ongoing testing and updating. And I think, again, similar to the identification point, something like an affiliated service provider or that's going to be pretty easy for the advisor to identify. Maybe a little less obvious that requires equal disclosure is if the advisor is receiving any sort of benefit from an unaffiliated service provider. Those also need to be disclosed. So, for example, if an advisor has a broad custody relationship and all of its pooled assets, all of its funds are leveraged through this custody platform and the advisor receives fees, that's a conflict and it needs to be disclosed. So again, walking through the toolkit for each of these I think is helpful in analyzing and identifying what the problem is and how to best protect the firm.
Brian, I think they're all good points, and I would say that if possible, just to underscore if one of your points there, if you can get information relating to fee comparisons, it is always helpful for the record, and we certainly advocate having a process for that. So if you have a BDC fund or another or private fund, sometimes it's a little hard to get data, but if you can get some independent metrics and put them in the file, I agree. That's always a good process to follow.
Hey, Mark, this is Craig. Just to follow on Salvatore and Ryan's comments, I thought they were very pointed. We had a couple of years ago, Foresight had a client that was in the real estate related space that underwent an SEC exam that was led by the private funds unit inside OCIE. And very deep exam, lasted about 9 months. And this is one of the key areas of the exam. And the SEC, there were about a dozen supplemental requests. They really dug deep, uncovered every rock related to some payments that were going to both affiliated providers and in-house staff. And really, a couple areas that became great points of focus. One was the contract terms. So the fund documents, in the SEC's view, they were questioning whether they were clear enough as to what amounts were going to be paid from the fund to these providers. And secondly, this firm had actually established a third-party vendor process where annually the independent vendor would do a review of the affiliated service provider, compare their services and costs to other vendors, and come up with a conclusion whether the fees and the services were appropriate. And the SEC even dug into that, looking at the process that third-party vendor underwent in terms of its survey and its analysis. So I think my point from this story, and fortunately the client got a minor deficiency, but I think the point is the SEC will look very closely, similar to the fees and expense issue, when it comes to affiliated providers. There's an inherent conflict, and I think the SEC will have a bias going in when they're looking at that relationship, a bias that the firm has engaged the affiliate for its own benefit and not the fund's benefit. And I think the reality is that oftentimes, the firm's affiliate is in the best position to perform the services, whether it's an underlying portfolio company inside a private equity fund or real estate. Because that affiliate knows the business, it's more efficient to hire someone that is affiliated. But, the SEC will definitely have a skeptical eye. And, just a practice point around this, I would include affiliates in your third-party due diligence process. And I would even say that when you're overseeing affiliates versus unaffiliated service providers, your process should be even stronger and even more documented to ensure that affiliate is performing services in the best interest of the funds and clients. And I think finally, going back to disclosure, I agree with Salvatore that you don't want to hem yourself in with rigid contract terms. Some issues I've seen with disclosure, I've seen firms disclose that there is a conflict, but not really disclose the nature of it. So I would always disclose, okay, yeah, there's a conflict, and here's why. And then secondly, it's really important, and this goes back to the Sunshine speech a few years ago. Andrew Bowden emphasized this, but really think about using your advisory boards. To me, they can be the saving grace for an advisor and a fund manager. If there's ever a question about whether something's a conflict or not, or in terms of disclosure, make sure your advisory board is aware of the affiliated arrangements, what the conflicts are, and the value assessment that the firm has made with regard to retaining that affiliate.
Oh, thank you.
Hey, Marc, it's Ryan. I want to.
Yep. Sure.
Just a quick comment, expansion on the disclosure documents. I agree with everything that's been said, but I think it's important to note as well that you can't be overly broad in the disclosures. The SEC has punished advisors for one instance. The advisor said we may use affiliated service providers. We may have this conflict of interest. I think it's important to identify that there is, in fact, a conflict of interest. So again, not over specific, but you need to disclose that there is one rather than there might be one.
Correct. Yeah, and this is Salvatore. I agree with that. We've specifically said that. So if you know you're using a service provider, just say it's an affiliated service provider. So, and we will use that person or entity.
All excellent points. We've certainly seen the SEC focus in the past few years on conditional language when there are absolute business opportunities taking place. So those are all excellent points. I love these responses, and they are both practical and really kind of chock full of roadmaps for how to address these issues. It reminds me that I forgot to mention that lest you try to take all and soak this all in now, today's program is being recorded. And we are offering general CLE credit for today's webinar. So be sure to fill out and return the webinar affirmation form. It can be downloaded and from the right side of your screen. You'll need to use the tracking code, which I will announce close to the end of the program. Also, we're covering a lot of ground here, so if any of you have questions, I wanted to remind you to feel free to use the question box. It's located in the control panel on the right side of your screen to submit those questions, and we'll try to get to as many of them as we can with the time that we have. So before we move on to the next topic, I wanted to highlight that the SEC specifically mentioned family members of affiliates. And I know there's been some mention of having the due diligence, go beyond, obviously the affiliates themselves. And I guess it's a general question about whether or not including policies and procedures to capture whether or not family members of affiliates may pose conflicts is sufficient. The SEC referenced is specifically an example in that regard. And so I'll open it up to whether or not any of you have experienced the SEC reaching, beyond the institution or the affiliates themselves to family members who either, innocently or in the worst cases, the SEC is looking at, malevolently shifting activity over to family members that may avoid detection.
Marc and Salvatore, I'd like to make a brief comment on that, if I might.
Sure.
We have seen the SEC ask that question, and we've also seen them ask a little bit even broader question to try, I think, to throw the net a little bit wider to capture that. And they've asked whether family members of key, CEOs or others that are high up in the organization, portfolio managers, are in the investment management business. So we are seeing that question.
And Marc, I think a straightforward process for a firm or CCO to engage in would be an annual questionnaire. I think that's the best way to flesh out from key staff whether they have any immediate family members who are involved in the investment business, involved with any affiliates. Obviously, if a staff member fails to disclose that, there's not a lot the firm can do if they're unaware of that arrangement. But I think the best thing a firm can do is just ask the question, document the family member who is in the business, and just oversee that periodically to make sure there's no conflicts. I would also suggest maybe periodically, once a quarter, you could have a conflicts committee or a compliance committee that once a quarter, once a year could kind of consider conflicts, and that might be one of them. Do we have staff with family members that are in the business, and is that a problem?
Absolutely. The spirit of the rule is to determine whether the advisor is incentivized to provide disinterested advice. So, I mean, it's a conflict. It's no less of a conflict than the advisor directly owning or being, having an affiliate that provides the service. So I think the same steps that we discussed previously apply equally here.
Great, thank you. Thank you. We often think of those annual disclosures as something to check the box, but there can be really useful information in there. Many institutions are used to collecting information relating to family members for personal trading policies, but they can certainly raise other issues that a chief compliance officer or others on the operational side may want to be aware of. So great, let's move on to topic number 2, conflicts related to preferential liquidity rights. here, OCIE has characterized this issue as inadequate disclosures of agreements entered with select investors through side letters and other means that establish special terms, including preferential liquidity rights. So this is an issue that has come up before. It seems to be a pretty vexing issue when these types of agreements that offer anything special, you would think would cry out for additional disclosure, and yet institutions continue to struggle with this. Ryan, I'll start with you for this question. What particular issues are presented by side letters that create preferential liquidity rights or SMAs invested alongside flagship funds, which OCIE mentioned in the risk alert?
Yeah, absolutely. I think the biggest risk with respect to side letters and preferential liquidity rights, an investor may not be aware, if sizable assets redeemed during stressed markets, it could lead the fund to gate. Now, and this, by the way, is more applicable to hedge fund strategies more so than private equity, just given that hedge funds offer liquidity more frequently than private funds. So the hedge fund could gate. There could be a significant markdown of assets if there's, a fire sale if significant assets leave the fund. So these are all things that the SEC wants to make sure investors are informed about in advance. And then kind of walking through the toolkit that could apply here, I think with the initial conflict that we discussed, it'd be easy enough for the advisor to identify investors with more favorable terms or separately managed funds that may have better redemption rights from positions that the fund's also invested in. So that stuff's easy. Avoid and mitigate where possible. Side letters are such a commonly used practice in the private world and hedge fund world that there's nothing inherently wrong with them as long as they're disclosed. So step three, really the heart of this, just adequate disclosure, full and fair disclosure, discussed with an advisory board, again, if an advisory board exists. And as we discussed last time, be clear that there is preferential liquidity terms for certain investors or certain other vehicles that are invested in the same entities. Don't just say there may be. Document it, and just ongoing testing. So if you have other funds that may not initially have side letters, but a big investor comes in and one comes up, it's important that you look at your disclosures on an annual basis for those funds and add disclosures as needed.
Mark, I agree with Ryan's points. This is Salvatore. One practical suggestion that we at Vigilant have as well is to put in the side letter some of the reasons why you're giving preferential rights. Because if you step back, I think Ryan made the point well. The SEC is looking at these preferential rights after the fact and saying, gee, these people in the group are getting preferential rights, and that's, there's some inherent feeling that there's something wrong there. Why should they be getting preferential rights? Now, we know there's good reasons for giving preferential rights, such as they're coming in early, they're in a riskier position, they're often bearing more of the risk of the fund that succeeds, while others at a later time do not have that risk. So this is your opportunity to put in some whys, and you can make your record and state, these are being given for the following reasons. And then also the optics are good. When you do disclose it, you might also disclose some of the reasons for doing so to your later investors.
Hey, Salvatore and Ryan, do you think there's a materiality threshold for disclosure here? And I was not surprised the SEC mentioned side letters because we've seen it in exams, their focus here, but I was a little disappointed they didn't really flesh out whether they would expect disclosure in all instances, and to whom the disclosure would be made, to what level you have to disclose. I mean, I don't know any of our fund clients that are handing over copies of side letters to all their LPs or even the advisory board. So I'm interested in your thoughts whether you believe there's a materiality threshold, because certainly preferential liquidity terms would be, in my view, very material.
Right. So this is Salvatore. I would say if there's preferential liquidity rights, you should disclose them, full stop. You know, even if it's small, just because they're in that category, particularly since it's been referenced here now by OCIE.
Right, but what about other side letter provisions?
I don't think
that's what I'm wondering about. Maybe less material, because
I don't think it requires.
You see a lot of side letters that have most favored nation. That's very common. There's other very common provisions. So I'm wondering whether SEC would expect, has a different standard, whether if it's a material provision or less than material.
I don't think it would require the advisor to turn over side letters per se, but noting in its disclosure documents and its PPM, for example, that there are preferential liquidity terms, and even maybe going as far as saying what those terms are. And to Sal's point, I thought it was excellent, noting why it's there. So the investor invested, a certain threshold of assets. But I don't think you need to turn over the side letter. Even in the case of most favored nation clauses, typically the identity of the investor is kept confidential. So the confidentiality of the letter is very important. I don't think the SEC would require the letter itself to be turned over. More for the investor's benefit, they're aware that there is a potential conflict, and what that means in terms of potential gates and future redemptions and markdowns and valuations. So more broad.
Okay, and then so perhaps a standard for if a firm is providing preferential liquidity terms or an other material benefit to certain clients, have some standard that's applied consistently as to which investors would be offered those preferential terms.
Yeah, I think I think that's right. There are the risk alert itself. You're right, is kind of conspicuous in its absence. It makes reference to materiality related to other conflicts, but obviously preferential liquidity rights is one where it may be important to know. I like the comments about giving some context about why the preferential rights may exist. I think it was Sal who said earlier in our presentation who referenced that, and the panels have noted that there are very often good reasons in a business to engage in them. The risk alert, though, does go through some pains to characterize those harms as any potential harms, and so that is kind of vague and squishy. And so the conservative course is probably to think about those disclosures, obviously without turning over the letters themselves. Clearly, the SEC wants to encourage firms to think about this in an expansive way. So, for what it's worth and what guidance that may provide.
Mark, in addition to, I know the alert mentions specifically disclosure of side letters, but in exams, the SEC has also been looking at how firms oversee and manage and track side letters, especially for firms that have a number of side letters with varying provisions in them. The SEC is going to expect that the firm has procedures in order to track those terms and ensure that that the firm is complying with those terms. So, I would, in terms of a couple practice tips, if your firm does offer a lot of side letters with varying provisions, maybe develop a log, establish a log that tracks those, similar to your PPM log. And then secondly, maybe consider an approval process where you're considering a new provision or a new preferential term for an investor, have an approval process around that.
Do you think there's anything in this guidance that is casting doubt on or criticizing the types of preference that typically, flagship funds or other institutions may have generally?
I think that's a good question. This is Salvatore. My view of it is they're giving some guidance on really material items that are important, such as the preferential liquidity rights, such as restructuring and preferences there. So I think that's important. Also, in the industry, there's often, as it speaks to this late in other parts of the OCIE guidance, there's often, similar funds that have the ability to also invest and co-invest in the same product. So an advisor might have an investment opportunity that is available to or a good potential investment for multiple funds, and then the advisor has to make the choice between what fund it puts in. It puts the opportunity in. So I think they're particularly sensitive to that. They've seen that. We've seen that. And what we would recommend there is that the advisor have a co-investment checklist that it establishes in advance. And then when an investment comes in that could go into multiple funds, such as an additional flagship fund and something that the SEC is looking at a fund that is not flagship, you want to have a co-investment paper trail that says, we could have sent it to these three funds, here's why we picked this one this time. For example, the answer may be, we just made a similar investment into the fund that was not selected, so we don't want as much exposure. Or the fund that we didn't put it in doesn't have adequate cash, or some other reason that the portfolio manager has other than it's like you're preferring one group over another. So I think you do see some substantive, some substantive feeling that these things aren't right to do, and at least if you give the SEC a paper trail that says, hey, we have a process, here's what we use, and here's how we do it. Vigilant was called in by an investment advisor. It just was a little bit too late, and we were about to do the exact analysis that we just outlined, and the SEC came in the interim, and or the SEC was already in on another part of the fund, part of the advisor, and the client never engaged us to do the work, but it had, they focused and spent a lot of time on it and really hurt the advisor, and the advisor ended up, getting enforcement action and having to sell the firm. So it had some bad effects. So I would say if you have the opportunity, get that co-investment checklist or get other documentation where you do have a situation like this.
Excellent points. And you've raised lots of good points. I agree that, all conflicts are not created equal, and the SEC certainly has heightened scrutiny of certain types of conflicts. One of the areas that you mentioned is restructurings, which leads us to our next point. The SEC discussed a number of different issues, and I'd say that restructurings, and a few others got less ink, but was certainly covered. And so let's dive into that. Craig, I'll start with you. How do you approach restructurings where existing investors have options to sell or roll interest to new or follow on private funds?
I think restructurings present a similar conflict to the next topic we're going to discuss, which is cross transactions. But I know the specific conflict the SEC cited in its alert on this was where an advisor would purchase fund interest from investors at discounts. And I think it's the same critical issue as with cross transactions. You know, what's the value? What's the appropriate value? It's obvious what the conflict is, you know, when an advisor is receiving interest from an investor. You know, so I think my bias in that situation would be to get an independent fair value, so that there's no question that that the investors are being treated properly. You know, I think, you know, in terms of stapled secondary transactions, yeah, I think number one, you have to disclose the conflict, and two, you know, think about why that stapled secondary transaction is in the best interest of the fund and its LPs. You know, it very well may be. I haven't seen these a lot, but obviously the SEC has, why they mentioned it in the alert. But I think obviously disclosure, number one, you know, in terms of full transparency, and then secondly, you know, the firm ought to really do an assessment, you know, why that secondary transaction in the interest of the fund and the LP.
Great.
Hey, Marc, I'll add to that. Sorry, Marc. I'll add to that. I think even disclosure to an investor up front that, you know, valuations may be less than what they could be had the position remained in the fund. I don't think that's enough there, because they do have the fiduciary duty to act in the best interest of the investors. So I agree. I think a great solution there is to use third-party valuation providers to the extent possible. Also, I guess that's the biggest point I had.
Just on, if you can use a third parties and Salvatore, that's great, and sometimes they're expensive, and particularly if you're doing a one-off service. Some people get them to review their portfolio on a quarterly basis or an annual basis, and that makes it easier. So if you don't have that luxury, which we hope you do, you can still create a pretty good record by showing the security, having some background, have a write-up, a page or two write-up on why the security is being sold from one party to another. If there's any indicative pricing or any similar pricing in another type of security, certainly put that in. So if you have to do it internally, just try to make the record as complete as you can. And establish, the whole goal is to show that you're not preferring one client over the other by selling at a lower price than you should. And there have been few enforcement actions on that. So you want to try and create a good record there. Again, this is your chance to make your record and put information down. On some occasions, there is a situation where you're selling the security out of one fund because the fund needs to raise cash, or the fund wants to make a significant investment or a follow-on investment in one of the SINs. So you want to put that in there because you're basically showing the SEC, well, gee, we may not have sold the security, on our own account, but it came up because there was an add-on offering, and this particular fund needed to raise cash. So again, this is your opportunity to make that record and do the.
No, excellent point. For those of you who are following along in your risk alert or may not have reviewed it fully, the OCIE risk alert went through a kind of a recitation of two examples, and it specifically mentioned the staple secondary transaction, which if it's not part of your lexicon, it actually had a footnote to describe it, which it characterizes as a stable secondary transaction combines the purchase of private fund portfolios with an agreement by the purchaser to commit capital to the advisor's future private fund. I also thought it was interesting that with many of the conflicts, they talk about them as an adequate disclosure of something specific. But here with the fund restructurings, they noted that many advisors are deficient more broadly in communicating with investors about the nature of the fund restructurings themselves and all the options that might be attendant to it. So we'll close out with our last topic, which we've already kind of teed up, that conflicts relating to cross transactions, and the OCIE risk alert says characterizes inadequate disclosures of conflicts related to purchases and sales between clients or cross transactions, and offers one brief example. Sal, I'll start with you on this one. What risks should advisors highlight in these transactions?
Sure. So thank you, Mark. So some advisors, for given the risk, they were given that they had an SEC review, and the SEC will always look at cross transactions. So you got to make sure that you have the information that you need in advance. So because they've been through a negative SEC exam and the SEC spent a lot of time on these, some advisors say we're not going to do anything with transactions. But suppose, particularly if you have a fund, you have a cross transaction that you want to do because some fund wants to get out of a transaction, but for unrelated reasons, they need to raise capital or something like that. So you are in a situation where you're often presented with the desire to do a cross transaction. As I said, I would, again, if you have the luxury of getting an outside, if there's publicly available data, that's the best. If you don't have that, you want to use an outside firm to do your valuation analysis. That's great. It sometimes takes long, and sometimes has a ticket price that's too high. And if you don't have that, the third best is to try to document it yourself with additional sales. And we've seen valuation committees often have information about the underlying financials, et cetera. So if you get a chance to make a good record, you want to do that. If you are in a fund or in a structure that has a valuation committee to pass on that, or an audit committee or something like that, that always gives you some extra protection because you get some outside entity to look at.
Yeah, this is
Mark and
Craig.
Brian, I completely agree with.
Yeah, go ahead.
Go ahead, Greg.
I was just going to say, I think there's a lot of scenarios where a cross transaction makes a lot of sense. Right now in COVID pandemic times we're in, it might not be a good time to sell a portfolio company, but if you're winding down a fund, you have a more recent fund that would benefit from that investment, and it's just not a good time to sell. So I've seen circumstances like that where cross trade makes perfect sense. Just to follow on Sal's comments, certainly keep both advisory boards informed. They should be definitely involved. Use a third party if you can, and then finally, if one or both of the funds is 25% owned, which should be fairly rare, but if the firm and its affiliates have 25% ownership, then it could transfer from a cross trade to a principal trade, which is much more significant and has a lot more stringent requirements around it.
Yeah, this is Ryan. I think they've covered most of the points with respect to cross-transaction. It's important for the advisor to remember that they need to seek best execution and most beneficial terms on behalf of both clients to act in the best interest of both clients. So it can be tricky in documentation and definitely third-party service providers where market prices aren't available are extremely key here.
Thank you. Thank you. Those are all excellent points. I will remind our listeners that if they have questions, they can put them into the box at the lower right and send them over to me. You know, this issue of the obligations of best ex, we talked a little bit about the obligations here. Obviously, there are fiduciary obligations on the advisory side, and so with that, I was going to ask whether or not, and this we had kind of a robust debate about this, about whether or not disclosures themselves provide sufficient, absolution, for your risks. Or are there conflicts that are a third rails, and whether or not you can carefully craft and fully describe conflicts in your disclosures and nonetheless fall afoul of regulatory scrutiny. Craig, what do you think about that?
Yeah, good question. I think easy answer is no. Disclosure is not enough. To speak back to the topics we've covered, I think the SEC recognizes that side letters are a common business practice, and I don't believe there have been any enforcement actions specifically on side letters. Affiliated vendors, I think, is much more significant, and on top of disclosure is fairly easy. I think the hard part on affiliate providers is to demonstrate value. And speaking back, I know the SEC in this alert didn't mention value, but Andrew Bowden in the Sunshine speech talked about situations where funds hired affiliated providers at questionable value. So the SEC is always going to want to see that the fund is getting value for what it's paying for. And then the last one on cross trades, no, disclosure is not enough if it's a clearly unfair deal for one side or the other. So I think the disclosure is important, but it doesn't get you all the way there.
Thank you. Thank you. One topic that has...
Mark? Hi, it's Salvatore. I want to, and if it's not the right time, we have a few minutes left, but we can postpone it. But I wanted some people sitting out there may have the practical problem of, gee, you guys have made a lot of great points based on what OCIE said, except my documents for my limited partnership or hedge fund, et cetera, were done before all these came out. And I now am caught between Scylla and the Cryptus, or in a rock and a hard place, and I have to go out, and I have the choice to go out between, going out to all my investors and repapering this whole deal, which you don't want to do, and potentially ignoring what the SEC is saying. So in certain circumstances, a practical solution will not. All right, we'd always rather have the documents look better, but we know sometimes we're stuck with the documents. So then what's an advisor to do? So you can do a couple of things. You can go out and send a letter to your LPs, or put a letter in with your quarterly report and says, say, here's how we handle certain items. Or you can do the disclosure in that mechanism, or you can put them in your ADV and do the disclosure. But it's always better if it goes directly to the investor. So you can make some of these additional disclosures. For example, some of the older documents don't have a good discussion of what can be allocated by the advisor to the fund. So, for example, it may just say certain fees and expenses can be allocated, but it doesn't say compliance, or it doesn't say valuation, et cetera. So you can put some of that in a disclosure letter, or drop it as a footnote in your quarterly statement that just flags it. So at least when the SEC comes in, you try to create your best record, and they say, well, listen, you charge costs for valuation. Your documents don't say you can charge those costs for valuation. And you say, true, SEC, however, we included this letter in August 2020 to our investors to let them know we do include those costs. So at least you take away some of their arguments, and you help your case.
Excellent point. Now, we've really gone over a lot of good points today, and we're winding down now. So I guess I'd like to close with a speed round, asking whether or not this particular risk alert represents anything new, and where we may want to go from here. And obviously, there's lots of things that are going on that are kind of inescapable in the world today. What's on the horizon, do you think, and how should advisors be treating this particular set of guidance from the SEC? Ryan, I'll start with you.
Yeah, great question. I think, this is nothing new, certainly. Private fund advisors have been looked at by the SEC for a number of years now. So I think just setting up the toolkit to identify conflicts, avoid or mitigate when possible, disclosing adequately, full and fair disclosure, adopting policies and conducting due diligence, and then ongoing testing. I think the ongoing testing is critical. To Sal's point a moment ago too, updates through a letter are helpful, but I think best practices, you want to look at the documents on an ongoing basis, at least annually, your recommendation, just to make sure that none of the information is static, because conflicts can arise at any moment. They do change, they go away, so all important to look at that. I think one thing that we need to address though is, even beyond the SEC's scope, if investors catch wind that an advisor, has deficiencies with respect to conflicts, it creates reputational risk for the firm. So it's definitely important for the advisor to stay on top of this and adopt a toolkit to monitor and effectively manage all these conflicts.
Good points. Sal?
I would agree with that. I think we covered the really important points, so I didn't have anything additional to that. Thank you.
Okay. Craig, anything in conclusion?
Yeah, I would just say my big takeaway from the alert is that, private fund regulation's here to stay. I know that a few years ago, the SEC, I think, overreached a little bit, talking in certain speeches about how private funds all need to have affiliated broker-dealers. And then after that, there was some talk about the SEC stepping back from private fund regulation. They've certainly been focused more on retail. But I think this alert reminds us that there's still some concerns at the Commission. Private fund regulation's here to stay. And, if you're a firm that hasn't been examined by the SEC in a while, or if you're fairly new, I would highly suggest, having a third-party firm, Thompson, Hine, our firm, Foresight, or Sal's firm, or another firm come in and take an independent look at your firm, make sure you're complying with best practices.
Excellent advice. I do believe that this type of oversight is here to stay as well. The takeaways I got from today, excellent ideas, is use cover where you can. If there are committees, use those committees. If they're not committees, create committees for conflicts, for valuation. Use your advisory boards and document. I want to thank everybody for participating with us today. If you are seeking CLE credit, The tracking code is TH as in Thompson Hine, AUG for August 12. Again, the tracking code is TH AUG 12. And as a reminder, the CLE form can be downloaded from the handout section of the user control panel to the right of your screen. I want to thank everybody for attending the webinar here today. If you're not currently receiving our updates and invitations, we invite you to go to Thompson Hine's website to register for our mailings under the Publications tab. When today's webinar ends, you'll be prompted to take a survey providing feedback, and we would welcome that feedback. It's important to us. The next webinar in our series will be hosted on August 26th at 11 a.m. where we'll be discussing fees and expenses and codes of ethics. Thanks for attending today. Thanks to my panelists, and enjoy the rest of your day.
Thank you very much, Mark. Thank you, everyone.
Thank you.
Thanks, Mark.